can see, I mean, this channel just absolutely amazing. And this is why I just absolutely adore charts because, I mean, they really give you a good clue. Yeah, so it does seem like the Fed is trying to get the market more used to the idea of tapering, which tells me that they're fully aware that they need to taper. We remember that the 120 billion they've been pushing into the markets on a monthly basis, that was an emergency measure back in March of 2020 because of the COVID crisis. Needless to say, with economic growth where it is and everything going relatively well here in the US, they don't need to do that anymore, and they need to start backing out of that. Now, this is totally different than raising interest rates. I don't know if they'll ever fully raise interest rates again, because I always think there's another crisis on the horizon. Now, having said that, there's actually some interesting price action going on in the market. So we saw the NASDAQ top out in a channel up here. And you can see, I mean, this channel just absolutely amazing. And this is why I just absolutely adore charts because, I mean, they really give you a good clue as to where price action is going to take you. So you can see that this trend line connecting all these highs. And every time you hit this high, you see a pretty significant sell-off. So here and here, and then we hit it right up here. And then look, we went right down to that lower trend line. Now the markets have bounced off of it, but it's a weak bounce. What do I mean by that? Well, certainly we're not shooting up. You're not seeing buy the dippers rip this market back up substantially. And what that tells me is the market will eventually break lower here. So my guess is over the next 2 weeks or so, you'll see a breakdown below this trend line and you'll start the next leg down on the NASDAQ. The S&P will likely follow. It's probably going to coincide with yields going a little bit higher. We've seen the yield move to the 1.6 area on the 10-year, and certainly that is making people a little bit nervous. So overall, I think you might have a little bit of chop here, but I think in the next 2 weeks, you're going to get another secondary leg down to this market.
And what type of size of correction do you think that we could be looking at?
So before a significant bounce, I'm in the camp that we need to at least test the daily 200 moving average. It's not a whole lot lower before we test that. In fact, if I show my chart here again, you can see that the 200 moving average is right down here around 340. So that's another 17 points lower on the QQQ. On the SPY, if I bring up the S&P chart here, you can see that's around the 415 level. So that would be about 30 points lower on the SPY. So I think that's where you'll see the first big stand by the bulls, by the dippers. A lot of the talking heads will come out and say, okay, we finally hit the 200 moving average. You're going to get a good bounce. Maybe we're going to go back to all-time highs. I think that's going to be a false positive, meaning that you are going to get a bounce off of that because it's a self-fulfilling prophecy. Investors that have been sitting and waiting for the buy the dip, they will buy there. But my guess again is this market is now going into a downward cycle. And we can see the downward cycle because very clearly here, and let me take away these moving averages, we've now put in a change in trend, lower low and lower high. So if you look back to March of 2020, we were always making higher lows. I mean, all along here, it's higher low, higher low. Same thing with highs, higher highs, higher highs. Well, that flipped. Here was a low, now a lower low. Here was a high, we bounced, we made a lower high. So what that tells me is that there's been a change in trend in this market that is now going to take us into, in my opinion, a bear market going forward. It coincides and it makes sense that it's with the tightening phase of the Federal Reserve, which is going to be pushed along by this inflationary pressure. And again, the Fed is even saying now, it's not just this year that we're seeing 7 to 8% inflation, it's next year. So they're going away from this transitory short-term inflation to now the concern about a longer-term inflation problem.
Okay, so inflation, moving away from the transitory aspect of it and more sustained long-term inflation here. And then we've got the threat and we've got the Fed talking about the tapering. Do you think that the markets are then preparing for that tapering and the removal of liquidity, or is it something more serious? And that if we get a breakdown, we get a serious taper tantrum, that we could see a significant correction in stock markets?
Yeah, so my guess is you're going to see this inflation bug start to freak the markets out more and more. Right now, we're still close enough to the all-time highs where you're still getting these people, these investors that have put more money in the last year in the market than in the last 20 years combined. So there's still average investor money flow that's coming into the market, and that's what keeps this market up. it's clear to me, I've seen so many examples of it where institutions are unloading heavily. So if you look at the market, how it's kind of made this rounded tops over the last, month or two, that's created by smaller investors buying and the institutions selling into it. That's why you get this gentle curve over versus a big drop. If it was just institutional selling, it would have been a sharp sell-off. So my guess is, again, you'll see the Federal Reserve be in a very tricky position where they don't feel like they can raise rates because the market will throw a tantrum, but the inflationary the inflationary jump and sustainability will actually cause the markets to raise interest rates for them. And that's going to be something very weird where the Fed could actually be looked at as losing control, and the market will get very scared at that. And I actually think that, after we hit this 200 moving average, there's at least 20% down after that will come. So again, it's not going to be instantaneous. Don't think I'm calling for a crash. But over the course of this next phase of the market, which will likely be, 12 to 16 months, you should see as much as 20+% down on the equity markets.
Would you have expected then to see appreciation in the precious metals on the back of this? We've been kind of trending sideways for a little while now.
Yeah, I'm in that camp where I think that gold especially is slowly getting ready to make a big breakout to the upside here. I've been kind of calling for year-end 2100 gold. It doesn't look at this point like that's going to happen, but I think you'll be well on your way to that level. So if we look at the GLD chart, for example, we can see that, even though yields have risen, which generally pushes down gold's actually held up relatively well since yields have pushed back to 1.6% on the 10-year. The other side of the coin, too, is that investors need to remember that when yields go up because of a strong economy, gold sells. When yields go up because of inflation, gold actually rallies. And you can see this going back to 1975 to 1980, where gold had a major move up during that period when there was high interest rates and high inflation. So again, I'm still watching. There's a couple things I'm watching on the GLD chart. There's a inverse head and shoulders here. So you have a shoulder, head and shoulder here. And sorry about that little pop-up there as we take that away. But nonetheless, you can see the inverse head and shoulders here. We're looking for a breakout at this level, which would take us back to this previous high. Also, this is a longer-term bullish pattern on the GLD. So if you look at the big move up that we saw, even going back here, big move up, this is all inside bar bullish consolidation. And that also is choreographing a further move to the upside. So again, I'm continuing, I'm actively looking to buy more gold. I hold gold as a swing trade, but I'm also looking to buy more physical metals at this point. Because again, inflation is not going away. When you raise labor costs, like what is happening out there, businesses can't pass 100% of that labor cost increase off to consumers day one. It's going to be something that over time they pass along, which will, bring their margins back up, but it's going to essentially increase that inflationary pressure.